December 2001. The seventh largest corporation in the United States collapses. $63 billion evaporate. Employees lose their savings. Wall Street freezes. But not because something happened, because no one understood how. This is the rise and implosion of Enron, a company that appeared to sell brilliance, made billions on paper, and then disintegrated while the world applauded. Chapter 1: The Make-Believe Empire. Picture a company making money by moving natural gas through pipelines. Oh wait, not dramatic, not glamorous, just boring infrastructure. That was Enron around 1985. A low-profile Houston pipeline business born from a merger only tax lawyers cared about. Then entered Ken Lay, PhD economist, permanent vacation tan, and one big obsession: deregulation. If the government stopped controlling energy prices, Enron could transform from a regulated utility into an energy trading machine. Suddenly, natural gas wasn't just pumped through pipes, it was traded, hedged, and speculated like Wall Street, but with a stronger smell. Lay recruited Jeff Skilling, a rapid-fire McKinsey consultant who worshipped markets, models, and himself. Skilling's vision: Enron wasn't a pipeline company, it was a technology company. We don't sell energy, we sell the future of energy. Wall Street swooned. The true breakthrough came with Enron Online, a digital marketplace for trading energy contracts. It made buying and selling gas feel like ordering takeout. Click confirm, millions move. Enron transformed from that Texas gas firm into Silicon Valley wearing cowboy boots. Media outlets cheered. Fortune crowned it America's most innovative company 6 years straight. Inside headquarters, the culture was ruthless. Skilling told employees they were the smartest guys in the room. Translation: be exceptional or get fired. Huge bonuses. Casual backstabbing, every quarter a survival test to impress investors. From the outside, Enron was a tech-savvy market genius. But ask a basic question. So what do they actually do? And you'd get a TED Talk of buzzwords and diagrams. The stock kept climbing, so everyone stopped asking. Meanwhile, behind that shiny exterior, the foundation was quietly starting to crack. Chapter 2: The Mask. By the late 90s, Enron had turned into a legend. Its stock shot from $7 in 1997 to over $90 by 2000, a 1,000% jump in 3 years. If you put your grocery money into Enron stock, you looked like a financial genius. The media called it a miracle. Executives treated it like a party. But the mathematics weren't matting. Enron had promised endless growth. No bad quarters. Ever. But energy markets aren't TikTok. They don't go viral weekly. So Enron changed the accounting rules. Enter mark-to-market accounting. Also known as, we're counting imaginary chickens that may not hatch and may not even be chickens. Example: Enron signs a 10-year energy deal. Instead of waiting for real money over time, they counted all 10 years of estimated profit immediately. Wait, is that allowed? We're doing it, so yes. On paper, Enron looked like a cash-printing monster. In reality, many deals were barely profitable, not started yet, or based on optimism that made horoscopes look cautious. When even that wasn't enough, CFO Andy Fastow stepped in. Fastow became Enron's chief financial storyteller. He built dozens of off-balance entities called special-purpose entities, technically separate, practically controlled by Enron. The trick: Enron dumped its worst assets into those entities and pretended it generated revenue. It was like selling your broken car to your dog, handing in your credit card to buy it, then telling your spouse, "Look, honey, I made a sale." Fastow gave the entities names like LJM1, LJM2, and Raptor because nothing screams transparency like random alphanumeric soup. While Fastow juggled flaming liabilities, executives cashed out. Stock options, bonuses, private jets, luxury homes. Employees were told to load their retirement plans with Enron stock. Their 401 might as well have said, "In Enron we trust." Meanwhile, Wall Street analysts gave buy ratings. Many worked for banks making millions from Enron's deals. Objectivity optional, revenue mandatory. Enron fostered confusion. If you couldn't explain something, that meant you were innovating. By 2000, Enron's armor looked unbreakable. until someone finally asked, "Where's the real money?" Chapter 3, Cracks in the Illusion, August 2001. Jeff Skilling, the Golden CEO, walks into his office, drops a resignation letter, and leaves. No scandal, no speech. Just, "I'm done. Peace." Official reason? More time with family. Translation: giant red flag. That same month, the SEC begins probing Enron's mysterious off-balance entities, corporate language for, "We smell smoke. Haven't found the bodies." So Lay returns as CEO and smiles like someone pretending not to panic. Inside, not everyone bought the act. VP Sharon Watkins noticed numbers that didn't add up. She sent Lay a memo. "I am incredibly nervous that we will implode in a wave of accounting scandals." An internal review followed. Lay treated it like a PR issue, not a confession of fraud. Journalists and skeptical analysts started poking around. Why is the business so confusing? Who owns these ghost entities? Why do financial statements look like they were attacked with a shovel? Enron replied with jargon and attitude, "We are a revolutionary energy trading optimization platform leveraging derivative arbitrage within a structured swap framework." Translation: "We don't know either." October 2001, the mask slips. Enron admits accounting errors. Corporate for, "We cooked the books till they burst into flames." Turns out $586 million in earnings were fake. Investors finally woke up. Sell, sell, sell. Sell the shares, the office chair, the family dog, whatever. The stock collapsed from nearly $90 to under $1 in 4 months. December 2nd, 2001, bankruptcy. Largest corporate failure in U.S. history at the time. $63 billion gone. Employees, many with retirement locked in Enron stock, lost everything. Executives? Skilling cashed out $70 million. Fasto pocketed $30 million. Lay sold millions in shares while encouraging workers to hold theirs. Workers got termination letters. Executives got oceanfront property. Chapter 4, the fallout. But wait, weren't auditors supposed to catch this? Enter Arthur Anderson, one of the big 5 accounting firms. They were supposed to be the referees. Instead, they poured drinks at the party. They audited Enron and made millions consulting for Enron. Conflict of interest? Massive. When investigators showed up, Anderson employees shredded documents by the box. Memos, statements, gone. They claimed it was routine record policy. Prosecutors disagreed. Anderson was convicted of obstruction of justice, lost its license to audit public firms, and collapsed. 85,000 employees gone. Not for committing the fraud, but for burying the evidence. Investment banks like JP Morgan, Citigroup, and Merrill Lynch helped structure the hidden deals. They paid fines, no jail time. Executives weren't as lucky. Skilling was sentenced to 24 years. Fastow got 6. Lay died of a heart attack before sentencing. Congress rushed to pass Sarbanes-Oxley, basically the Please Stop Lying Act. Chapter 5, The Illusion. But Enron isn't just a crime story. It's about belief, illusion, and how badly people want to believe in the next big thing. For 16 years, Enron sold the future, and everyone bought shares of the dream. When the lights switched on, the building was empty, the numbers were imaginary, and the smartest guys in the room were gone. As someone once said, "A lie can travel halfway around the world while the truth is still putting on its shoes." But the deeper lesson wasn't about accounting loopholes or courtroom drama. It was about how fragile trust really is. Markets aren't powered by pipelines or spreadsheets. They run on belief. As long as people believed Enron was transforming the future, the machine kept humming. The moment doubt sparked, the entire illusion collapsed like a house of cards in a wind tunnel. Years later, former employees still describe the shock of seeing their life savings disappear overnight. Many had framed stock certificates on their walls, wore Enron jackets with pride, brought their kids to company picnics. To them, it wasn't just a job, it was identity. And that was the true tragedy. A company that preached innovation and brilliance ended up teaching a brutal lesson about hubris, greed, and the cost of refusing to ask simple questions. In business schools today, Enron isn't celebrated, it's dissected. Professors rewind old interviews, students analyze the famous memos, and everyone whispers the same uneasy question. How did no one stop this? The honest answer? Because the story was too good, the numbers were too shiny, and the crowd was too eager to believe. Sometimes the smartest people in the room aren't the ones who know the most, they're the ones who ask why when everyone else is clapping. If you like this breakdown and you want more wild, true stories from the business world, hit that subscribe button and join the journey. Now tell me, which personal story do you want to see next on the channel? A CEO downfall? A Wall Street scam? A tech cult? Drop it in the comments. Your suggestion might be the next episode.